don't buy REITs. Do this instead, and you can make $1,000 per month consistently. And here's the kicker. This strategy doesn't involve investing in individual stocks, mutual funds, or bonds. Instead, it taps into a little-known, boring, but wildly effective investment strategy that almost no one is talking about right now. And the best part, you don't need to be a finance expert, have a lot of money to invest, or know everything about the stock market. And so whether you're a complete beginner or just someone looking for a proven low barrier method to generate consistent income, this is a strategy you have been waiting for. And by the time you finish this video, you'll know the exact strategy to make $1,000 a month or more on autopilot. So let's jump right in. I want to first talk about why you shouldn't buy REITs. And if you don't listen closely as to why you shouldn't buy them, you could easily lose thousands of dollars. I've been there myself, and I know exactly how that pain feels. I wouldn't want you to make the same mistakes. And so before we can talk about why you shouldn't buy REITs, let's first define what are REITs. And I want you to think of it this way. When you buy stocks, there's a wide variety that you can choose from. Some are tied to healthcare, others are tied to technology, and some even focus on precious metals like gold or silver. But REITs are different. Unlike ETFs that can span across various sectors, REITs are laser focused on one thing, and that's real estate. That's why they're called real estate investment trusts. Their value is directly tied to the ups and downs of the real estate market, which can be good or bad depending on how you look at it. When it comes to the good, REITs can help diversify your portfolio, giving you exposure to the real estate market without owning a physical property. And then when it comes to the bad, REITs are incredibly sensitive to interest rate increases. Even a small increase, let's say 1%, can cause the value of a REIT to plummet. Just take 2022 as a prime example. When the Federal Reserve raised interest rates aggressively to combat inflation, many REITs saw massive decline. One standout was Medical Properties Trust Inc., or MPV, which lost over 50% of its value throughout the year. And so the issue with REITs is that they're closely linked to the real estate market. And when the market tanks, REITs struggle for months, if not years, to get back to where they were before. In addition, if the tenant chooses to pay late or not pay at all, then the stock could easily be worth less than it was the year before. And you might be wondering, why is that even the case? And it's because REITs rely on rental income to make money. If their income goes down, so does the value of the investment. And just to give you an example, as you know, the demand for buying products and services online has drastically increased, with Amazon and eBay taking a huge portion of in-store sales. And because of that, retail and mall-focused REITs have seen a huge decrease in value. Now that you understand all the reasons why REITs are going downhill, I want to reveal the actual strategy that blows all REITs out of the water. And I plan on using this exact strategy to make $1,000 a month and hopefully very soon $10,000 per month. And so this strategy is using covered call ETFs. And just to give a quick summary of how covered call ETFs work, the fund manager sells call options on the underlying stocks held in the ETF, which helps generate income for investors. And so I do recommend you do some research on how covered calls work. I'm just glad that in this video, I can introduce you to covered calls and more specifically, covered call ETF. And what's great about covered call ETFs is that the underlying asset in these ETFs are typically high quality stocks, which means that they increase in value over time. In other words, you're not only earning from the high dividend yield ranging ranging from 7 to 12%, but you're also benefiting from the long-term growth of these assets. And so hearing all those benefits, I know you're like, covered calls are amazing, but let's do a head-to-head comparison. And so for the first comparison, let's look at the growth potential of each. And so while REITs are tied to the real estate market, which can be seasonal and slow to appreciate, the underlying stocks in covered called ETFs often grow in value over time. This gives you the benefit of both consistent dividends and potential long-term asset appreciation. Now let's move on to the next comparison, and that's sensitivity to market condition. And so when it comes to REITs, they are highly sensitive to increases in interest rates, which significantly can reduce their value. And let's compare that with covered call ETFs. And so although they are affected by market conditions, there's a lot more stability built in through the covered call strategy, which generates income from option premiums rather than solely relying on rental income like REIT. And then for the last comparison, we have the dividend or distribution payout. And so you can find REITs and covered call ETFs that have up to a 12% dividend yield. And so with both strategies, you can get a high payout on a reoccurring basis, but with covered calls, you're getting the best of both worlds because you're also getting the appreciation on the underlying asset. Now that you know just how amazing covered call ETFs are, let me tell you 3 that are a must and that you need to check out. And the first one is JP Morgan NASDAQ Equity Premium Income ETF, also known as JEPQ. This one by far is my favorite. As of the time right now, they have about 11% dividend yield, which means that $100,000 invested in this one covered call ETF can pay you out about $1,000 a month. And this is passive income. Well, all you have to do is put your money into this ETF and sit and wait while $1,000 each month is deposited into your account. Moving on to the next ETF, we have JP Morgan Equity Premium Income ETF, also known as JEPI. And this is a kind of like a much safer sister or brother to JEPQ. What's nice about JEPI is that it's been around a little bit longer than JEPQ and is held up strong in the stock market and has consistently grown in value. And then lastly, we have the Amplify CWP Enhanced Dividend Income ETF, also known as DIVO. And with this covered call ETF, it focuses on high quality, large cap, dividend paying stock. And because these stocks have been around for a while and are good quality, they're then able to pay out a really solid dividend as well as appreciate in value. As you've seen in this video, covered call ETFs provide a more consistent and reliable way to earn passive income. Let me know if you have any questions in the comments below. And if you're curious about an investment that has even higher returns than a REIT, make sure to check out this video right here.